What are the red flags that can trigger an audit? Well, this is a question I get a lot of, and people are always trying to understand. The audit red flags, and actually the IRS has some pretty good helpful information on their websites about this. One of the things they look at is a high DIF score, and this is some proprietary software the IRS has where they analyze your return and they look for inconsistencies and differences. For example, let's say you live in a very affluent area and your income tax return reflects very low income. That's going to add to your DIF score. Sometimes incorrect Social Security numbers. If you're Schedule C self-employed, I would advise you to consider a corporation if you can do it, because frankly in the last 5 years that's all I've seen is audits of Schedule Cs, whether or not they have any red flags on the returns or not. That's one area the IRS really focuses on. Home offices is a red flag. It's something that if you put it on your return, you have to make sure you meet the rules. Sometimes family members on the payroll. These people should really work for you, and it's something that if the IRS looks at, they're going to challenge. So you need to have time cards, you need to have paychecks, you need to really document this well. And it's perfectly fine to do that. You just want to make sure you're covered. Unlikely business deductions. For example, let's say you have some huge travel bills, and you own maybe a small retail store, or let's say you own a beauty shop, and you have thousands of dollars in travel every year. That may be something that looks strange and could trigger an audit. Again, you might, as a beauty shop owner, you might travel to several conventions every year, and that's fine. I mean, again, they're perfectly good deductions. You just need to keep your documentation. Excessive entertainment, especially as it relates to your business and comparative to other businesses in the SIC code for your business that the IRS looks at. Errors and omissions, math errors, incomplete or sloppy returns, unreported income, 1099s, they'll come after you for that, audit or not. Disagreements between the state and federal returns, round numbers ending in zero. If you have like $10,000 of this expense and $5,000 of that expense and $2,000, I mean, they can tell for looking at that you're estimating. So anyway, and that's not, they'll come in and they'll deny those expenses and they'll make you have the record keeping. Charitable contributions, disproportionate to income, high contributions, low income, suspiciously low income for your SIC code. Let's say you are a professional and your income is extremely low, that might generate an audit. High itemized deductions, sometimes just having a high income, drastic changes in income, and participating in tax scams. Believe it or not, there are tax preparers out there who are known by the IRS for filling out returns that are not accurate, and once they get a hold of those people, they audit all of the returns they can find with that person's number on it. So you need to be careful when you see something that's too good to be true, and someone ropes you into something that doesn't make any sense, because a lot of times if it's too good to be true, it is. Anyway, take all legitimate deductions, document, and be prepared to defend yourself. Do not be afraid of an audit. Be prepared to win. This is Peter Holtz. I have a lot more ideas and frequently asked questions on my website, www.financialperformancecenter.com. Thanks a lot.